Okay, that's good. Yeah, I hear now. All right, well, thank you guys for your patience and for coming out to the presentation. As Dan said, this presentation is titled Demystifying Forex Trading, How to Capitalize on Intermarket Correlations. And I'm really excited to share this presentation with you because it's something that's relevant pretty much regardless of which market you trade. I know Forex trading hasn't had a lot of penetration here in the US. It does offer some unique opportunities that I'll go over as we move on, but even if you're not particularly interested in trading Forex exclusively, it's a market where you want to have a knowledge of some of the dynamics because it can have a dramatic impact on the stock market, the commodities market, and the bond market, among others. So it's definitely something that I think traders of all stripes will be able to take away some valuable lessons from today's presentation. Before I get too far ahead of myself, I do want to share this risk disclaimer. I'm not going to read the whole thing to you guys, but at a high level, this just basically explains that trading any market is a risky endeavor, so you should only use risk capital that you can afford to lose. We also really emphasize the importance of risk management and position sizing to make sure that one or two bad trades can't knock out your whole account, and that's especially a risk in the Forex market. We'll talk about some of the pros and cons at the end of this presentation, but leverage is both a pro and con of the Forex market, and we'll talk briefly on that, but there's your risk disclaimer. So what are we going to be going over today? We're going to have a quick slide on the basics of intermarket analysis, and then we're going to break down how stocks, bonds, and commodities impact the Forex market. So if you've traded some of those markets before, you already have a leg up on trading the Forex market. And we'll also talk about the converse, how the Forex market impacts stocks, bonds, and commodities. All of these relationships are really reflexive relationships, so one impacts the other in kind of an endless circle here. And we'll highlight some of the strongest correlations there. And then most importantly here toward the end of today's presentation, we'll highlight how you can use Forex trading to capitalize on this intermarket knowledge. All right, so basics of intermarket analysis. Intermarket analysis is the study of the relationships and interactions between different capital markets. Pretty straightforward, and the advantages of intermarket analysis, or the primary advantage, is that it can provide a broader view of market trends. It can help put movements we're seeing in the market into context. And crucially, and something we'll talk about toward the end of the presentation, it can help traders improve their profitability potentially by providing confirmation or divergence of a market movement. I don't know about you guys, but I've occasionally had trades where with any trade, there's always pros and cons, and you might see something and you're like, yeah, this indicator that I look for is in alignment, but this one's just not quite there yet. Intermarket analysis is another tool that you can layer on to help hopefully shift the odds in your favor and incorporate into your process. It's just another way of looking at the market. Another kind of mini disclaimer here, though, it is merely a tool like moving average, like looking at GDP growth or something like that. It's not a panacea, so these intermarket relationships, they are complex, they're constantly evolving, but in today's presentation, we're going to focus on some of the most intuitive, some of the most consistent relationships. So these are ones that have been proven over years to be fairly reliable. But again, just want to reiterate that it's not perfect. You won't always see everything work out as well as they do on some of the charts in today's presentation. All right, so let's get into how different markets impact the Forex market. So how do stocks impact Forex? There are two key terms that we want to become familiar with. The first is risk appetite. It's a gauge of the optimism or pessimism in the market, and it's something that impacts investment activity across all markets. The other term we want to be familiar with is pretty much an FX-specific term. It's the carry trade. Some of you may be familiar with the carry trade. It's basically a strategy where you buy a higher yielding currency while selling a lower yielding currency. Of course, in the FX market, I think as Dan mentioned at the last presentation, it's always a pairs trade. So whenever you buy one currency, you're selling another one. With this carry trade, traders seek to buy the currency with the higher interest rate, sell the currency with a lower interest rate, and make that spread between the two interest rates as kind of like a tailwind for their trade. So let's walk through an example here. Again, we're talking about how stocks impact the Forex market. When traders are feeling optimistic, when risk appetite is high, they tend to buy stocks and they also tend to buy higher yielding currencies. In terms of rebalancing their account or how they fund those trades, they might look to sell bonds, which are seen as a less risky asset, and they sell lower yielding currencies, which are often considered to be safe havens. And of course, vice versa. When traders are feeling pessimistic, they tend to sell their riskier investments, things like stocks and higher yielding currencies, and they tend to buy bonds and lower yielding currencies. So they're more focused when risk appetite is low or we're in a period of risk aversion, traders are more focused on returning their capital, not getting a return on their capital. So today's presentation will be particularly heavy on charts. I always like to say a picture's worth 1,000 words. This one might be worth 10,000, but this is the quintessential example of the carry trade and a very close relationship between markets. Here we have in blue the Australian dollar against the Japanese yen. Of course, these are both very developed economies, but Australia has been, I think it's been something like 28 years since the Australian economy has experienced a recession, and as a result, Australia tends to have relatively high interest rates compared to many of its other developed market peers. Of course, the direct contrast there is Japan. Japan's economy feels like it's been in almost like a 20-year stagnation since the Japanese were taking over the world in the late 80s and early 90s. And as a result, the Bank of Japan has resorted to very low interest rates to try to stimulate the Japanese economy. So the quintessential carry trade would be to buy Aussie yen. The other line I have on this chart is, of course, the S&P 500 index of large cap stocks, and you can see this very tight correlation heading into the great financial crisis as traders started to get very scared in late 2008 and into 2009. We saw aggressive selling of Aussie yen, aggressive selling of the S&P 500. We did finally bottom out almost 10 years to the day from today. I think it was March 6th or March 9th, 2009. In any event, we've seen a very consistent rally since then in both Aussie yen and the S&P 500. We're going to revisit this chart at the end of the presentation, so just keep this one in the back of your mind. We're going to zoom in specifically on Aussie yen and S&P 500 around the great financial crisis and talk about how you could use some of the lessons from today's presentation to potentially trade around that and maybe get ahead of the crowd in terms of identifying this major reversal, this major bottom in the S&P 500. All right, so that's how stocks can impact the Forex market through that channel of risk appetite. How do bonds impact the Forex market? Central bank interest rates are the major driver of currency values in the short term. I don't know about you guys, if you guys had an international economics class or a finance class or something. This is not actually what the textbook will tell you happens. The textbook actually says currencies with a higher interest rate or countries supporting currencies with a higher interest rate tend to depreciate over time. That's, at least in the short term, in the real world, not what we're seeing. We see a direct relationship between interest rates and currency values, at least in times of normal risk appetite. So key dynamic here, short-term bond yields fluctuate with expectations of future central bank interest rate changes. So two keywords here I want to flesh out a little bit more. Keep in mind that markets are forward-looking. They tend to discount future development. So it's not just when a central bank moves interest rates, say in December when the Federal Reserve raised interest rates, that in and of itself didn't really have a big impact on bond yields in the bond market because the market is forward-looking. The Fed has been at great pains to tell you in advance what they're going to do. And in fact, by November, the market had heavily discounted that the Fed would raise interest rates in December. So we want to look at changes relative to expectations, and we want to look at changes, right? Sometimes the direction of movement in interest rates can be more important than the absolute level. And this kind of gets into the forward-looking traders trying to get ahead of the next carry trade in advance. Here I've got a chart, two completely different instruments. We have the US dollar index in black and 2-year treasury yields in green. I think this period covers, it looks like about March of last year into the end of February of this year. So about a 1-year chart. You can see that very close relationship throughout the last 3 quarters of last year. We saw 2-year treasury yields rising. We also saw the US dollar index rising. Interestingly, and this is what I was just talking about here in terms of the market looking ahead, traders started to anticipate that the Fed would go on an extended pause as we moved into 2019, and that's where we saw bond yields dropped off, but the dollar has held up relatively well. I haven't had a chance to update it in the last week or two here, but I think the dollar index was back pressing those highs again. So we have a pretty clear divergence, and we'll talk about later in today's presentation what that could mean. But just for the moment here, just want to highlight that strong relationship that we saw throughout last year between the bond market and the FX market. One more impact on the Forex market is from commodities. This is probably the most straightforward one. A lot of newer FX traders, this is one of the first things they become familiar with. It's the idea that certain economies depend on exporting raw materials to other countries. So as a result, there's a direct relationship between the prices of certain commodities and specific currency values. So all else equal, if the price of one of your exports rises, that's a good thing. That's bringing more money into your economy, and that is also a good thing for your currency. The quintessential example here are the so-called commodity dollars among the major currencies. So the Canadian dollar tends to be closely correlated with oil prices. Of course, Canada drilling a lot of oil, exporting it commonly to us, though U.S. has become a much bigger producer of oil recently. Tight correlation in Australia with the mining industry, so copper and industrial metals tends to be the strong correlation there. And in New Zealand, and the New Zealand dollar tends to be closely correlated with dairy products. So it's not just me saying this, I can prove it with charts here. Here we have a chart of the Canadian dollar against the US dollar. Notice that the Canadian dollar is the first currency here. So that's indicating this is basically how the Canadian dollar is moving relative to the US dollar in black. And then we have WTI crude oil, obvious close correlation here across the 2014 to 2019 period. The Australian dollar relatively closely correlated with copper over the sample period 2011 to 2017 looks like. Strong downtrend in both. And the best one I could get here for the New Zealand dollar was milk powder futures as a proxy for dairy prices. And it's not perhaps as tight because it's not quite a perfect spot market of dairy prices, but you can still see that correlation there with milk powder futures falling off at the beginning of the sample through 2015. And then especially here on the right half of the chart, 2017, 2018, we can see a lot of the same peaks and valleys there with those milk powder futures and the New Zealand dollar, and that's how commodities can impact the FX market. So this first half of the presentation here can provide insight into how you can use some of your knowledge from other markets, if you have experience trading other markets, to trade FX and kind of get up to speed more quickly. A lot of the questions I get from newer traders, a lot of the questions I've gotten so far just in the last 24 hours here at this trade show has been, you know, how do I know when a currency is going to move and what are the factors that impact it? This is a pretty strong example of some of the correlations that can impact the FX market. But even if you've randomly stumbled in here, you're not really interested in trading FX, I think it's still very, very important to have a knowledge of the FX market and how that can influence other markets. So here we talk about how the Forex market can import stocks. This might be the most in-depth portion of the presentation, so hopefully I can explain it properly, but there are two main impacts we're going to go through. The first one I think is pretty intuitive here. It's domestic versus foreign stocks. So I've noted here, fluctuations in the value of the dollar directly impact investors' returns on foreign stock investments. Now that doesn't really mean anything by itself. Let's walk through a quick example. The main index, like the equivalent of our Dow Jones average here in the US, in the UK is actually called the FTSE. If the FTSE index rises 15% relative to the perspective of a UK investor, that'd be a pretty good return, right? Over the course of a year, you're kind of just sitting on your hands, you're buying probably an index with a relatively low cost, maybe that UK investor would be happy. But from the perspective of a US investor, if we see the dollar gain 10% against the pound over the course of that holding period, that'll cut into your return and that US investor will make a little bit closer to 5% on their investment. So hopefully that's clear. It's not really too complicated. I have another bullet here. We're going to revisit that bullet. It's actually more relevant for my next point. So charts. I always need to back up what I'm saying here with charts. So you can see dollar index in blue, And what we have here in black is a ratio chart. This is the S&P 500 versus the EFA non-US developed market. For those of you who might trade the ETFs, we're looking at SPX divided by EFA. So this black line isn't an instrument per se, it's just a comparison of the two types of stocks. So therefore this black number up here, it's 43 or something at the end of the sample, doesn't really mean anything, but we're looking at the trend. And when this black line is going up, that means that the S&P 500 or US stocks is gaining value relative to non-US stocks. And we can see this backs up what we talked about on the last slide. As the dollar strengthened, that cut into the returns of those foreign stocks, and they tended to lag the returns of the S&P 500 throughout the middle of last year, actually throughout the entire second half of last year. So if you're, I know even for traders who aren't active, who are just long-term investors, it would make sense to have exposure to foreign stocks from a diversification perspective generally, but you might want to adjust the exposure you have to foreign stocks based on what you think is happening with the dollar index, or at least keep an eye on it, because that can be a very hefty headwind for foreign stock investments. It can also be, of course, a benefit, not really shown on this chart, but if the dollar is falling, that provides a benefit for foreign stocks relative to US stocks and can further juice those returns. One more way Forex impacts stocks is from the perspective of importers versus exporters. Of course, it's the 21st century. Businesses are increasingly coordinating and competing across the globe, across oceans, not just across town. So I want to walk through a couple of examples here to explain what happens when the dollar rises and when it falls, depending on what type of company we have that we're discussing here, whether it's a net importer or a net exporter. So net importer, picture a company that brings in raw materials from overseas, manufactures a widget here and sells it primarily to US investors. So we'll see what happens when the dollar rises. That means that all else equal, the expenses of that importer will fall because their currency here in the US is stronger. It will take fewer US dollars to buy the same amount of raw materials, and when your expenses fall, your profits tend to rise. Of course, we have the opposite scenario. If the dollar falls, from the perspective of a net importer, expenses, all else equal, rise. It will take more US dollars to buy the same amount of that raw material, and rising expenses is something that can lead to a fall in profits. Net exporters is, of course, the other side of the coin. So picture a company that creates something here and then sells it primarily overseas. Actually, in the US, a lot of our importers are service-based companies that provide services to overseas businesses and consumers. So if the dollar rises for a net exporter, revenues fall. Why do we see revenues fall? Well, from the perspective of the consumers in other countries, it seems like the cost of the service or good of the exporter is rising because it's priced in a currency that's rising. So all else equal, there'll be less demand for that product. We'll see revenues fall and profits fall. And of course, the converse is true. This one's actually a little bit easier for me to conceptualize. For a US-based company, if we see the dollar falling, that means that the product or service that the US company is exporting is more attractive and cheaper for foreigners, and therefore we tend to see revenues rise and profits rise. This, I'm going to disclaim, is probably my worst chart in this presentation, and the reason it's my worst chart, if anyone has a solution for me, I'd appreciate come up and talk to me afterwards, but there's just not a great index of importers and exporters. The best proxy I could find was the Russell 2000, which tends to be smaller capitalization companies. Those tend to be more importers and companies that sell domestically versus, and I use the S&P 500 as a proxy for those net exporters. The S&P 500 is some of the big companies that you may be familiar with. They're more likely to have customers around the globe, and I don't have the exact numbers, but it was something like slightly higher proportion, maybe 20% higher exporters here among the S&P 500 than the Russell 2000, but it's not great. You can still nonetheless see this correlation here as the dollar index fell throughout the start of 2017, throughout the entire year of 2017. The Russell 2000, those small cap stocks that are more likely to be net importers, underperformed the large cap net exporter proxy that we have here, the S&P 500. And conversely, when we saw the dollar bounce up at the start of 2018, that's when we saw a big bounce in those small cap stocks. So again, this may or may not impact your trading strategy, but it's certainly something to be aware of, because this is how Forex can have a big impact on stocks. And certainly if you're trading individual stocks, you might want to keep that in mind too, thinking about companies that might import a lot from different countries. The dollar index is going to be a key dynamic to keep an eye on. Okay, how does the Forex market impact the bond market? Well, this is pretty much just a restatement of a topic we've touched on a couple times already, but there tends to be a positive relationship between currency pairs and relative yield spreads. The strongest correlation is with short-term 2-year yields, and I want you guys to keep a close eye on the chart when I share it, because this is maybe the tightest correlation, the closest relationship in the entire presentation. So, as I noted at the beginning, all of these relationships, this one in particular, are reflexive two-way relationships. Because you could argue here this spread between bond yields in different countries. So we're talking about the example of the 2-year yield, for example, in Australia compared to the 2-year yield in the United States. You could argue that's the bond market really driving the Forex market, but the reason I've included it on this slide is due to the relative volume difference. The bond market is keeping an eye on the Forex market and what's happening there, and conversely, of course, Forex traders are keeping an eye on the bond market, but as you'll see, there's a ton more volume flowing through the FX market. This study that I found said that the global bond market does about $6 trillion in volume quarterly. Now that's a big number. You can't really even conceptualize $6 trillion, but we can compare it and see that the Forex market does about $5 trillion in volume daily, so almost the same amount. And that's why I put it here in how Forex impacts bonds, because the Forex market has a lot more volume flowing through it, and these bond market traders are taking a cue off of what's happening in the FX market. Look at this chart. This is great. I love this chart. You can see a super tight correlation here. This is the Australian dollar versus the US dollar in blue, Aussie 2-year yields versus US 2-year yields in red. I don't need to explain what's happening. Those two lines are moving almost perfectly in sync with one another. And in fact, internally at our team at Forex.com, when we look at developing what we would call a fair value model for what a currency might be expected to trade at based on what some of the factors that contribute to its value are, you always see this short-term bond spread as being a major contributor and often the most heavily weighted tool that we're using. So if you zoned out for the rest of this presentation, just remember this one. Close correlation there between relative bond yields and currency values. One more relationship to talk about here, and I'm doing just fine on time. I want to talk about how the FX market impacts commodities. This is a pretty straightforward one, I would think. Most global commodities are priced in terms of the world's reserve currency, which is the US dollar. That means there is a mechanical inverse relationship between the value of the US dollar and those global commodities. What does that mean? Basically, when the dollar rises, all else remaining equal, it takes fewer dollars to buy a given amount of commodity. So the obvious example here, I don't know what gold's trading at exactly. Let's call it somewhere around $1,300. If we were to see overnight the value of the US dollar rise 8% or so, nothing else changing with the supply and demand dynamics, that in and of itself would mean it would take fewer US dollars to buy gold, and we might see gold drop to about $1,200. So this is an effect we see over longer periods of time. Of course, we don't often get 8% moves overnight, but this is a very straightforward and, like I said, mechanical relationship. It has to happen that way because they're priced in the US dollar. Vice versa, of course, a US dollar falling makes gold appear more expensive in terms of the number of US dollars it takes to buy an ounce of gold. It just occurred to me that I didn't go back and cover another bullet point, but that's all right. Yeah, particularly strong relationship with gold. And there's one other reason this relationship between the US dollar and gold, this inverse relationship, is strong, and that's due to opportunity costs. Gold, not to denigrate any gold investors or traders, but at the end of the day, gold is kind of just a shiny yellow rock. It's a shiny yellow rock that's held its value for millennia, but it's not an operating business like a stock is. It's not giving you coupon payments like a bond would. It's just a yellow rock, so it's not putting money in your pocket on a day-to-day basis, and in fact, it actually is taking money out of your pocket on a daily basis. If you think about it, you have to pay to store your yellow rock. Oftentimes, if you've got a lot of yellow rocks, you might be a target for someone, so you need to like have security around. So there's an opportunity cost to holding and protecting gold investments. Even if you just hold paper gold through an ETF or something like that, there's still an expense ratio on that, so you don't get the full zero return of the gold. And that opportunity cost isn't, necessarily super significant. Maybe if you just have a couple ounces, you just throw it in a safe in your house, safe costs $40, whatever, you're happy. But as we start to get more, those opportunity costs are more substantial. And I also wanted to highlight here that that opportunity cost is in relation to what else you could be doing with your money. So in the US, we've had super low interest rates for an extended period of time. It might make gold seem more appealing if it's like, oh, I could buy a treasury bill that yields, sub 1%, or I could put money in my savings account instead of buying gold, but that's only paying me 0.05%. Now we've started to see interest rates rise, and the relative cost of holding gold has risen as well. So that further contributes to this inverse relationship between gold and the US dollar. So here's our chart. Pretty straightforward here. We have the dollar index in black, gold in gold. I did that one right. So we see some weakness here at the start of the sample, at the start of 2016 in the dollar index. That provided a tailwind for gold. Gold saw a pretty significant rally. I don't have the exact prices on there, but it was a pretty big rally here in gold. Then the dollar turned around in about the middle of 2016, started to rally. That was a headwind, drove gold lower. And I really like this point here, right? Kind of in the middle of the chart at the start of 2017, both markets reversed almost to the day at the exact same moment. Once the US dollar started to fall, and it continued to fall throughout 2017, that provided a big tailwind for gold. Gold had a strong 2017. 2018, almost the exact opposite scenario. Dollar strengthened, that was a headwind for gold, and therefore gold had a rough year. Kind of had an interesting dynamic going on right now where the dollar index has held up relatively well. Gold has also had a strong start due to some macroeconomic factors we see, and that underscores a point I made earlier. These aren't always going to work perfectly, but across this sample, a very strong relationship, and over the long term, I would anticipate that both gold and the US dollar won't continue to trend in the same direction for a long period of time. So, I do not anticipate they will continue to trend, right, because we have this direct inverse relationship almost. You'd need a lot of buying pressure to overwhelm the headwind of the dollar strengthening, and over the long run, that market will balance out. It's a good question, yeah. Generally speaking, right? Yeah, because, yep, and it's a good question. The question was, will we see this over a long term, see that negative correlation reassert itself? It's my assertion that we will, and I think that's pretty well backed up by what we've seen over longer periods of time historically. But good question, thank you. All right, so we've covered a lot of different correlations here, how the FX market impacts stocks, bonds, commodities, how stocks, bonds, and commodities impact FX. But how the heck do you use this for your trading? Like, it's pretty nice to make these fun little charts. We're going to talk about two concepts, two pretty straightforward concepts, but walk through some specific examples that you might be able to integrate into your trading strategy. The first concept is confirmation. As you might expect, you're looking for confirmation between different markets. So if a move in one market is accompanied by a corresponding move in a market that should be correlated, many of which I've just covered in this presentation, it's more likely to be a legitimate move, or more likely to be a move that continues. And the example, I think, does a good job explaining this. So let's take this from the perspective of an FX trader. You're looking at Aussie yen. Remember, this is our quintessential carry trade currency, and you see it break out, a bullish breakout, I should say. So it's going above a resistance level, and you're thinking about buying it because that's what matches up with your strategy. But maybe you're not 100% on board. You're worried about U.S.-China trade war, maybe that's something that could get in the way. Maybe the RSI is overbought. So you just don't quite know whether or not this is a trade you would want to take. Well, you could integrate some of the things we've talked about in today's presentation on intermarket analysis and say, well, what's going on with some of those markets that Matt said should be correlated? Well, if we see a rising stock market indicating that, that risk appetite is on board, that would be a sign in favor of that Aussie yen breakout continuing. Excuse me. You might also look at the Australian government bond yields. Remember that very closely correlated chart we saw earlier? That tends to be a very strong signal for continued strength in Aussie yen. So let's actually walk through this example. I like this. We'll kind of walk forward in time here from that same example I just highlighted. So a lot going on in this chart. Hopefully you can kind of see some of the key levels we'll be highlighting here. But we've got Aussie yen in blue. We're going to take this from the perspective of an FX trader. So we're trading the blue market. But we've also layered on for confirmation the Aussie 10-year bond yields in green. Also could use the 2-year yields. And then we have the S&P 500 in red. Now these should all be correlated based on what Matt is telling you. We'll see if it works out that way. And what we've got here is just that example I outlined on the last slide. Aussie yen, it's a bit difficult to see, but the blue line has broken above its previous high from back in July, technically in June. So there's your breakout. Do we think it's more likely to be legitimate or not? Well, we see the green line here, 10-year bond yields in Australia, still below their resistance level from May there. So they haven't had a breakout yet, and in particular, the S&P 500 is lagging. That indicates that risk appetite is not fully on board. Traders are not looking to put on their carry trades too aggressively yet. They're not, you know, too optimistic on the future prospects for the global economy because we see the S&P 500 is below its resistance level. Let's walk this. So if you're an Aussie yen trader, you might sit on your hands. You're like, I'm not getting enough confirmation. There's some signs of concern here. I'm just going to avoid entering the trade right now. Let's walk this chart forward a couple of days or weeks here. And you can see we've actually gotten what we were looking for. Aussie yen, the blue line that we're focused on trading, really hasn't moved that much. It's nudged up a little bit there. I think that's on the right chart. So it's gone from, let's call it a little over 81 to around 82. So maybe you might have missed out on a little bit of gains there if you were considering buying Aussie yen. But more importantly, from this hypothetical example, we've seen Aussie 10-year bond yields skyrocket. That green line is just blown through resistance. That's indicating rising yields, more attractive carry trade scenario for buying Aussie yen, and we've also seen risk appetite get on board. The S&P 500, right as I've stopped the chart here, is breaking above resistance. This is where you'd say Aussie yen holding its breakout, confirmation from the bond market, confirmation from the stock market. This chart was getting kind of crowded, but you could also layer on those copper or industrial metal prices we talked about earlier. This is where you might have more confidence to look to buy Aussie yen from an intermarket perspective. And as we can see in this hypothetical example, Aussie yen continued to rise, as did all the other markets. And that's one way you can use confirmation as a possible signal to confirm a trade you were considering. All right, the other concept I want to touch on here is divergence. Divergence is the opposite of confirmation, so we actually saw maybe an element of divergence in the last slide. So we're looking for divergences between normally correlated markets. That indicates a market that is more vulnerable to a potential reversal. This is why our hypothetical trader might have been more hesitant to take Aussie yen on the initial period of time until we got that confirmation. So let's take this one from a different perspective. Obviously, we have traders of all stripes here. Let's say you're a U.S. stock trader, and we see U.S. stocks break out. But if you see the Aussie yen falling, if you see bonds falling, that would give you a little bit of pause there about buying that breakout in U.S. stocks. This is an important bullet point. It might be one of the most, it might be the most important bullet point in the whole presentation. These divergences are seen at major tops and bottoms. I like this. A couple people just got their notebooks out to scribble that down. This will be on the test. So major tops and bottoms, and this works across different time frames. If you're a short-term trader, it might be, you know, a top for the week that we might start to see some divergences. If you're a swing trader, it might be a top for a month or a quarter of the year. And as we'll see on the next slide, if you're a longer-term investor, we often see these divergences almost always, in my experience, see these divergences around major multi-year or even generational tops and bottoms. This was the first chart in today's presentation. This will be the last chart in today's presentation. Here we have Aussie yen. I think I changed the color here, but it's in green now. S&P 500 in black. Here's that divergence that was present. I didn't really touch on it too much in the first slide, but here we see Aussie yen holding up relatively well, whereas the S&P 500 has dropped off sharply. And just for reference, this is heading into the great financial crisis. So 10.5 years ago, this is 2008. Looks like this chart goes through about September of 2008. We saw the S&P dropping off, Aussie yen holding up. How would we interpret this? Well, if we're an FX trader, we're thinking about buying Aussie yen, might want to tap the brakes on that because we're not getting that risk sentiment confirmation from the S&P 500. Conversely, if you're trading the S&P 500, you might say, yeah, there's a lot of scary stuff going on. You know, Lehman Brothers is on the verge of collapsing, but Aussie yen's holding up relatively well. I might not be looking to sell the S&P as aggressively yet until we see which way these two markets come back into alignment. Well, as you guys probably know, spoiler alert, it did not work out well for risk appetite. But what's interesting here, and I don't know if this will come through in the online presentation, but for those of you here, you can see actually that this period through maybe September and October, the S&P held up relatively well. It was primarily Aussie yen coming in alignment with the S&P 500, indicating that fading risk appetite, traders abandoning those carry trades, trying to back up the truck on safe haven assets. And that could have maybe provided a bit of a cue that things were negative under the surface. Both the Aussie yen and S&P 500 were dropping off. I was watching markets at this time. Literally no one predicted the scale of this, but as we all know, it got really, really ugly in the fourth quarter of 2008. S&P dropped off a cliff, Aussie yen dropped off a cliff. I've run this chart through the end of October here, and you can see both of these markets are hitting new lows. That's confirmation, arguably. They're both moving in the same direction. They're both dropping off a cliff. There's not really much to be optimistic about at this point. And again, from that perspective of an S&P 500 trader, I wouldn't really see enough to get me interested in trying to pick a bottom here. Let's run this chart forward a couple of weeks. Here's the first moment where my antenna would be perking up. We saw the S&P 500. It's a bit difficult to see here, but this black line went on to make a new low. So very bearish, lower highs and lower lows. That's the textbook definition of a downtrend. But we saw Aussie yen actually make a bit of a higher low. Sorry, I'm also favoring this side of the room. We'll let you guys see what I'm looking at here too. So we saw a slightly higher low here in the Aussie yen, indicating that maybe things weren't quite as bad as S&P 500 traders were feeling. Of course, this is brutal, and I'll be the first to tell you I was not buying the S&P at this point. But if I'd gone to this presentation, maybe inevitably there'll be a situation somewhat like this in the future. You can use some of the things we've talked about today to maybe get your antenna going. So that would be the first sign that maybe things aren't quite as terrible as they might be. What really is interesting here is as we fast forward into March, almost exactly 10 years ago, we know with the benefit of hindsight that the S&P 500 made its ultimate low around this period. But what's interesting here is even if you're watching it in real time, watching this expected correlation with Aussie yen, you would see that Aussie yen did not make a lower low again, despite the S&P dropping off and making another low. So we have a double divergence, and these tend to be even stronger signals. Again, I'll tell you, I was pretty bearish on the market here. I was not using some of the tools that I'm sharing with you now. We all grow and continue to learn things. It can be difficult to buy at the bottom of a market. In fact, it's near impossible. But as we all know, that was the ultimate bottom for the S&P 500. It's gone up 400% or something from there. But the reason I wanted to highlight this is not to say I'm a perfect trader. Now that you've attended my presentation, you'll be a perfect trader. But rather just to use this as a tool. And if you're watching this, you might have been more likely to treat this bounce in the S&P 500 as legitimate, maybe even just slightly sooner than you otherwise would have. I know a lot of traders who didn't get back into the US stock market until 2012 or 2013. Well, maybe if you'd seen this signal, you were more attuned to the potential for a bottom forming because we saw this divergence with Aussie yen. That might have just pushed forward that period when you felt comfortable getting back in by 6 months or a year, and even that's something that could be beneficial. So it's not a perfect tool, but it's definitely something that especially at those major turning points that we often see a big divergence. And if you're not looking across different markets, this is a tool that wouldn't even be in your repertoire. So I did want to quickly mention some advantages of Forex. I know we have traders from all different markets, so at a minimum, hopefully you've taken some lessons from Forex that can be used to trade other markets, but some advantages of the Forex market. There's leverage offered up to 50 to 1. This is something that can magnify your gains if you're right on a trade. It can also magnify your losses if you're wrong, but it is just another tool to have in your arsenal, and it's something that can be a benefit in certain circumstances. You can trade 24 hours a day during the market open. Many of you may be familiar with this by now. I think Dan mentioned it in his last presentation, but obviously that's a major benefit. The US stock market is open 6 hours a day, maybe, and it's when we're all busy, or many of us are either working or watching the grandkids or something like that. So another advantage of the FX market is it's open 24 hours a day. Two-way market. I think this is a really cool one. So we've shown a lot of charts here of things going up and down. The FX market, it might be the easiest market where you can short as easily as you can go long because it's a pairs trade. So anytime, even if you buy a chart in FX, you're selling the second currency to buy the first currency, and conversely, you could just sell that first currency to buy the second. So it's a pretty seamless transition there. If you thought gold was going to go lower, or you thought the S&P 500 was going to go lower, there's some different regulatory hoops you'd have to jump through to be able to short those markets, whereas all of that it can be potentially more easily enacted through the FX market. Quick plug for Forex.com. Of course, we're on all your lanyards here, but I just want to highlight that we are the largest U.S. broker. We've overcome regulatory hurdles to serve the U.S. clients for 20 years. So we have a booth in the other room. If you want to talk to me after this presentation, if you have questions on anything I've mentioned, please do come check us out. So let's go over a quick summary. Intermarket analysis, as we now know, is the study of the relationship between stocks, bonds, commodities, and Forex. It can help traders improve their profitability potentially by providing confirmation and divergence of a market movement. Do keep in mind, though, these relationships are complex and constantly evolving, as this gentleman pointed out, with the strength we're seeing in gold and the dollar index right now. And of course, traders can use their knowledge of other markets to take advantage of the 24-hour-a-day leveraged Forex market. So that's kind of the gist of this presentation. Does anyone have any questions here? I got another minute or two, and of course I'll be here for the rest of the day. Yeah, go ahead.
Great presentation. I'm a long-time trader, love futures and currencies, but I made an observation. Have you noticed how much volatility has dropped in Forex markets in the last few years? Take $0, you have at least 120 pips a day, it does about 16 pounds, US dollar, etc. The only reason for the only thing I think is that all the nations of the world are producing so much currency. Like stocks all of a sudden been like 2-for-1 splits, and there's more shares outstanding, it doesn't move as fast. Way down in currency markets.
Yeah, it's a good question. So the question was basically whether we've observed and whether I have a possible explanation for why volatility in the FX market has been so much lower lately. I don't have one off the top of my head. It seems like everyone, I like the way you brought stats to it. The gentleman highlighted that the range on euro dollar might have been 120 pips a couple of years ago. Now it's gone down from there. It always feels like we're in a volatile market. We have, stories about Brexit going on and trade wars. So it definitely is a trend that we've noticed, and you can objectively quantify that with indicators like average true range, maybe some longer term Bollinger Bands and standard deviations. I don't have a perfect explanation for that, but volatility tends to be cyclical. So we go through periods of low volatility and high volatility, and it works across different time frames too. So we might be in a longer term period of declining volatility, but we still can see different volatility cycles within a day-to-day scenario. So you want to keep an eye on it. I don't think volatility is permanently lower. I think it will rise again. I think the analogy might be the situation in stocks. 2017 was an absurd year for stocks. There was absolutely no volatility, and even people still managed to complain about it, but I don't think we saw a drawdown from peak to trough in the S&P 500 of more than 3% in 2017. That came back with a vengeance here back in 2018. We saw almost two 20% drops over the course of the year. So don't have a pat explanation for why that's going on in the FX market, but I don't think it's a permanent scenario, and I would be cognizant of the potential for volatility to come back.
I was wondering if it might have been due to all the currency printed by either central banks or the Treasury
Yeah, that's a valid point. Yeah, that might have, yep. So it's the idea that central banks, I don't want to say getting a better grasp on the economy, but certainly being more easy in terms of monetary policy to fade out some of that volatility could be a factor. I think that's a good point. Any more questions? I got time for one more if we have one. Yeah.
Do you think there's really a difference between trading the New York session against the London session as trading opportunities?
Yeah, good question.
Like stay up 2 a.m., 3 a.m.
Yeah, right, drink your coffee. So the question, if anyone didn't hear it, is whether there are any differences in trading the New York session versus trading what I would call the London session or the European session in FX, because as we've noted, FX is a 24-hour market. So you do have a different subset of traders. I would say that overlap between the two periods, so in the morning US from say 8 a.m. to 12 a.m. is oftentimes one of the better times to trade, depending on your strategy, but that's when we see the most liquidity because it's the afternoon over in Europe, it's the morning here, so traders from both regions are in the same location, and that's also when we get the release of a lot of data. Sometimes central bank meetings in Europe will be in the afternoon, and the morning data from the US comes in. So I wouldn't say there's a big difference, but those tend to be the most liquid times, and especially the overlap between them is the most liquid time. So oftentimes you'll see lower spreads, more consistent market movements, but maybe we can go into more detail about specific differences, but there's not a lot of differences between those two sessions. The Asian session, on the other hand, we're in the afternoon as I'm recording this, it does tend to be a little lower volatility. Oftentimes you see lower movements, so that's the one where you see the big difference in my experience in the FX market. All right, thank you guys for coming out here. I do want to encourage you to stay in touch with us. You can follow our the research team of which I'm a part at ForexCom on Twitter. We do market updates, daily analysis, articles, and that's a good way to help get up to speed with really all the markets we've discussed. And I also want to highlight again that we have a booth. You can feel free to visit our booth for more information. If you want to explore opening a live or demo account with us, that's something that we can help you with as well. I do want to take just a quick moment also to note that I have a presentation tomorrow. It is at 11 o'clock. I think it is in this same room, so anyone who's coming back tomorrow, a completely different presentation. It's on cognitive biases or different faulty scenarios with our thinking that can really shortchange your trading. And it's something that I think is relevant regardless of whether you're a technical trader, fundamental trader, short-term, long-term, whether you're trading stocks or FX. So I'd really appreciate it if you guys could check out that presentation as well. Other than that, thank you guys for coming out, and catch up with you guys soon.